Looking forward.
Thank you very much, Sebastian, and thank you everyone for your attention. I'm sorry I can't be there in person, but it's a real pleasure to be here and to talk a little bit about commodity traders and the book that my colleague Javier Blas and I wrote about them, The World for Sale. So I'm going to switch to a presentation in a second, but just as a word of introduction about both commodity traders, commodity trading, and the book, The World for Sale. Javier and I are both journalists. We've been writing about commodities markets and commodities industry, probably some of the companies that you guys work for many years, about 15 years in my case, maybe 20 in Javier's case, with different areas of specialism. And for a long time, really, Javier and I were talking about the commodities industry and saying, and the people we were talking to were saying to us, there's these guys who are really important and influential, or we'd be asking what was moving the oil price today or the copper price, and they'd say, well, of course, it's such and such a company. They've got a big trade on. And we kept hearing about these commodity traders. And yet, when we looked to go and read and teach ourselves and learn the background of this industry, there was very little written about them, very little published in the form of books or even newspaper articles, and when we started asking people about them, similarly, everyone seemed to think that they were terribly important, but most people in the commodities industry, and certainly outside of the commodities industry, didn't know very much about them, or outside of the commodities industry hadn't even heard of them. And so we set out to try and change that, with the view that commodity traders actually are very important on a number of levels. They're big and important companies that deal in very large volumes of commodities and large amounts of money. They create a lot of wealth for themselves and also the people and companies they work with. But more than anything, they are enormously influential in global trade, but also in geopolitics and economics. And just as an example of that, and it's a story, for those of you who've read the book, it's a story we tell in the book, but it's really the thing that for us got us into writing about the commodity traders was in 2011, when there was a civil war in Libya and there was a group of rebels rising up against Colonel Gaddafi. And we were writing about the war, we were writing about its impact on the oil market, and the rebels were making some progress in early 2011, but they had a big problem, and their big problem was they didn't have enough fuel to power their military vehicles. Because although they were in Libya with big oil resources, they didn't control any of the key refineries, and so they didn't have enough fuel. And then the whole thing changed, and it changed because of a commodity trader. The then CEO of Vitol, which is the largest oil trader, flew into Benghazi in the middle of this civil war, and with a little encouragement from some political allies of the rebels in various governments in the West and in the Middle East, he struck a deal with the Libyan rebels to supply them with fuel to power their vehicles. This deal went on for many months. Vitol ended up supplying on credit $1 billion worth of fuel to the Libyan rebels, and this deal totally changed the course of the war. We have comments, people who were fighting in the war have said it, and it was very obvious to us writing about it at the time that this deal changed the course of the war. Gaddafi, as everyone knows, was deposed, was killed. What happened next in Libya is a long and not entirely happy story, but it really brought home to us the enormous importance of what commodity traders do, and yet it's often in the shadows. People don't understand very much about it, and so we really felt that this was a subject that needed more understanding from everyone, both in the commodities industry and outside it, both among politicians and regulators and among ordinary people. And so we wrote The World for Sale. And with that, I will start my presentation if I can manage to make it work. Let me see. I'm going to share my screen. And then I'm going to do the presentation. There you go. Hopefully you can see that. So just to start you off, this is a chart of the profits of the world's four largest commodity traders: Glencore, Vitol, Cargill, and Trafigura. The metals industry, people in the audience, I'm sure, will be familiar with Glencore and Trafigura. Vitol is the world's largest oil trader, Cargill the world's largest food trader. At various points in their histories, they have also dabbled in the world of metals. And just to bring home quite how extraordinary the last couple of years have been for the commodity trading industry, the profits of those four companies alone, all of whom, apart from Glencore, are privately owned by relatively small numbers of people, were almost $50 billion last year, by far the highest on record. And just a bit of scale comparison for the metals industry people in this audience, that is more than the profits of BHP and Rio Tinto combined. And yet these four companies receive far less scrutiny than BHP and Rio Tinto. They're not owned publicly by shareholders, with the exception of Glencore. So really, there's a very small handful of people, senior executives at Vitol, Trafigura, family members at Cargill, who control these companies that made these enormous profits last year in the middle of the huge disruption of commodity markets we had because of the war in Ukraine. And we're making more money than BHP and Rio Tinto, the two largest international mining companies combined. Now, last year was an extraordinary year for the commodity traders, but actually, commodity traders being extraordinarily profitable is not an entirely new thing. In our reporting for the book, we spoke to a number of former executives, for example, of Mark Rich & Co., who told us that in 1979, the year of the second oil crisis and the Iranian Revolution, Mark Rich & Co. made profits of $1 billion, which, okay, that doesn't compare much to $50 billion in 2022, but in the dollars of the day, $1 billion made Mark Rich & Co. one of the 10 most profitable companies in the US and probably the world in 1979. And yet, there was very little attention being paid to it in those days. A little bit more in a few years later, thanks to Rudy Giuliani. But in 1979, people were paying very little attention to Mark Rich & Co. So really, that's just an example and a demonstration of both the scale and the importance of the commodity traders, and also how people ought to be paying more attention to them than they are. To talk you through a little bit of the history of the industry that we tell in the book. The commodity trading industry, as metals folks in this audience I'm sure will know, is as old as human economic activity. Certainly, it's been going on for thousands of years. A lot of the traders of today, the large trading companies of today, trace their history back to the metal traders of the 19th century. In Germany, I'm thinking of companies like Metallgesellschaft that grew up in Germany in the Industrial Revolution, trading largely in scraps and residues, the offcuts of the Industrial Revolution, that then became a profitable trading business and really built a lot of the key the foundational elements of the model of the trading company that we see today. Things like a partnership owned by a number of employees or family members, the culture of hard work and always chasing business, the huge importance they put on relationships with their customers and their suppliers, and really the understanding of the commercial side of all aspects of the business that they're dealing in. That was really pioneered by those German metal traders in the 19th century, and then taken up by some of the pioneers of the modern day commodity trading industry, which you can see there in front of you. Probably the company that has most resonance historically in the metals world is Philip Brothers, which for a long time was the dominant metals trader. Grew out of the Second World War and the economic boom that took place after the Second World War, and Philip Brothers from New York was the company that really capitalized on that. Had offices in dozens of countries around the world at a time when the word multinational was totally unfamiliar to people. And the man who really drove that growth was a man called Ludwig Jesselson. And out of Philip Brothers came several other companies. So Mark Rich, a name known, I'm sure, to many of you, left Philip Brothers because he wanted to make more money and set up on his own to set up Mark Rich and Co. Mark Rich and Co, of course, became Glencore and also gave birth to the other major metals trader today, Trafigura, because Trafigura was founded by a bunch of disaffected Mark Rich and Co executives. The other man on this screen is Theodore Weiser, might be less well known to those of you in the metals world, but he was really a pioneer of the oil trade. Mark Rich is often credited with founding the oil market, and in many ways that's right. He really pioneered the spot trade in oil in the late 1960s and 1970s. But actually, some of the first trades by a trader in oil were done by Theodore Weiser, who flew into Moscow, the Soviet Union, in the early 1950s to strike deals with the Soviet Union, buying oil from them, first of all oil products, then refined oil for his company Mabanaft, and really was one of the very first oil traders. There were four big shifts in the global economy that really allowed traders to go from a relatively niche industry, certainly important in their world, but not on the scale that I was talking about in the beginning, doing deals that shape the future of countries. And they were, as I mentioned already, the growth in the global economy after the Second World War. The second was the opening up of the oil market, which had previously been very much controlled by 7 large oil producers and prices more or less fixed. In the 1970s, with the oil crises, the countries of OPEC took control of their own resources, and suddenly they needed somebody to sell the oil, and that was the oil traders, first among them Mark Rich, but also others. The third big development was the collapse of the Soviet Union, which opened up a huge new source of supply for commodities, and also was an enormous opportunity to profit for a number of commodity traders. It was by many estimations the largest closing down sale in history. You had we've heard stories of traders who told us, for example, about in 1990 selling some metals to the Soviet Union, and then in 1991 buying back the same metals at a quarter of the price, still in the same packaging that they'd sold them in. And then the final big development that has really supercharged the commodity trading industry and brought it to where it is today and where it can make $50 billion last year was, of course, the rise of China since the turn of the millennium, that has added a vast amount of new demand, driven this massive bull market that has been hugely profitable for the commodity traders. So that brings us back to the present day, when they're making, just to remind you, this vast amount of money. How are they making this money? Well, a big part of it has been the volatility in the energy market, but that's brought with it very significant risks. And just to demonstrate that, here is a chart of Glencore's value at risk, a measure of the risk that they're taking in their trading. And that this is an estimate of how much they stand to lose on any given day. And you can see that in 2022, last year, that number went through the ceiling, where previously they'd been a very bad day for Glencore would have seen them losing $40 million, give or take. Last year, that quadrupled to $160 million. And that's really a function of this huge volatility in energy markets, what's happened with the war in Ukraine, concerns about the shut-off of the flow of Russian commodities to the world, that has left commodity traders holding positions in gas and oil in extremely volatile markets, where prices are going up a lot, where it's very hard to hedge, and that has led to extremely volatile earnings and extremely high risks, but also, as we saw, extremely high rewards. I mentioned earlier one of the theses of our book is that commodity traders are very important and play a big geopolitical role. Another part of that thesis, or what goes with that, is the idea that we ought to pay more attention to them. And it continues to surprise me and Javier, and I think it's surprising to most people to see just how limited the knowledge and understanding of many governments and regulators, and some people in the private sector, some of the companies dealing with commodity traders, is of what they're doing, how they're doing it, how they make money, what their role is. So here is just a selection of comments that we've seen, particularly in the last year or so, as energy and energy prices and energy markets have really come to the forefront of the political conversation. And suddenly politicians and regulators have realized, actually, there are these commodity traders who handle very significant volumes of the markets, who are absolutely critical to, for example, the question of whether Russia can sell its oil above the price cap, or whether Russian commodities continue to flow onto global markets. And yet there is very little understanding, very little information even about what they're doing. Or to take another example, which drew a lot of regulatory scrutiny, the nickel price spike and squeeze and short squeeze on the London Metal Exchange last year. Again, I think there was a realization across regulators that a lot of the trading in the nickel market had been taking place on the over-the-counter market off the London Metal Exchange, and there was very little information about that people not only were not particularly regulating or controlling the trading in the over-the-counter market in nickel, the kind of thing that commodity traders are doing, but are not even aware of it. And you've seen now since then a push led by the London Metal Exchange, but with quite a lot of support and pressure, depending on how you think of it, from the regulators, to try and get more information on that. But I think we're still at the early stages, and it's certainly not happening across the world and across markets. And it's still the case, I think, that politicians, regulators have a bit of a blind spot when it comes to physical commodity markets, in part because that's very hard to pass laws about. It's very hard to regulate. It needs to be something that happens across multiple countries, and we all know that regulations across multiple countries are pretty hard to agree and effect. I mentioned already the nickel squeeze, but the other area in which commodity traders make headlines these days is when they do something wrong, or when somebody does something wrong to them. And it has really been a feature of the last few years, probably in part because of the volatility in the markets, but also I think because there is beginning to be a bit more regulatory scrutiny, that we've seen a lot of headlines about commodity traders wrongdoing. I mentioned Vitol earlier, the largest oil trader that struck that deal in Libya to change the course of the war. In 2020, they settled with the US government, who found that they had been paying bribes in 3 countries in Latin America over a period of 15 years, up until July 2020. So, when you think of commodity traders delivering bags of cash, and you think that must be something from a past era, well, maybe it is now from a past era. Certainly, that's what a lot of the commodity traders would say, but it's not a past era that was very long ago. In the case of Vitol, okay, they weren't delivering bags of cash; they were wiring money to offshore bank accounts. But it was happening as recently as July 2020. Glencore, on the other hand, was literally flying around the world with bags of cash, which they were getting out from the cash desk of their head office in Bar. And they pleaded guilty last year in the US, UK, and Brazil. There are still some investigations into them going on in other jurisdictions, and prosecutors there found that bribery was built into the corporate culture at Glencore. A UK judge said corruption was condoned at a very senior level within the company. Again, this was across 7 different countries in Africa and Latin America. They, in several cases in Africa, were quite literally putting several $100,000, euros of cash onto a plane and flying it to somewhere in Africa to deliver as a bribe. One more case that I suspect has taken has caught the interest of people in this audience is the case of Trafigura and Pratik Gupta. Trafigura shocked, I think, most of us back in February when it revealed that it had been the victim of what it described as a systematic fraud against it, perpetrated by, it alleges, Pratik Gupta and a number of companies connected to him, where Trafigura was trading with these companies, was paying them for cargoes of supposedly nickel, and then it turns out that these cargoes didn't have any nickel in them, and Trafigura stands to lose almost $600 million. One of the interesting facets of this case is that it really has demonstrated some of the lax controls in the commodity trading industry in some companies, I should say. I'm not suggesting this is true across every single company. For example, Trafigura's own court filings say it was paying out against bills of lading that contained HS codes showing what the container was supposed to have inside it that didn't match what it was supposed to have inside it according to the contract that Trafigura had signed. And another example, even more recently from last week, which I'm sure will be a topic of conversation in this event, is that of Arubis, where Arubis has revealed that it's been the victim of what appears to be a fraud, which involved some inside, or Arubis suspects involved some inside assistance from some Arubis employees, where again Arubis was paying for consignments of complex scrap, and paying on the basis of a certain laboratory assessment of what it contained. But in reality, the contents was totally different, and Arubis seems to have lacked the internal controls to catch that until they'd lost upwards of 100 million euros. So it's a fascinating industry. It's a really important industry. It's an industry that is involved in big economic and geopolitical events. It's an industry that makes a vast amount of money, and it's an industry that has often been found to be on the wrong side of the law. It's one I think we should all be paying more attention to. I hope that I have persuaded you in this presentation to do so. If I've persuaded you to buy the world for sale, I'll be even happier. But even if not, I hope I've inspired a bit of interest in commodity traders in you, and I'll be very happy to take some questions.
Yeah, thank you very much, Jack. This was a great presentation. And now we're taking some questions from the audience. There's one in the back.
Well, Jack, first of all, thank you very much for providing so many insights into the world of commodity trading. Obviously, you are an expert of commodity trading, which I'm not. So I have an interesting question. How is it possible that Trafigura did not detect this fraud earlier? Don't they test the goods they are receiving? We're talking about thousands of tons. We are not talking about a truckload. I'm not an expert, but I think it's pretty obvious that they should have detected it earlier. What's your view on that?
Yes, I agree. I think, I mean, Trafigura itself has said on several occasions since this came out publicly that that they recognise that there are lessons for them to learn from this, and that they're reviewing their processes and systems. Part of the reason why, and one of the interesting facets of this case, part of the reason why they didn't pick it up sooner, I think, is that they weren't buying this material in order to supply it to a stainless steel mill, say, because if they'd been doing that, it would have been found out pretty quickly, right? If you buy a cargo of nickel, supply it to a stainless steel mill, the stainless steel mill opens it. The stainless steel mill opens it and discovers it's not nickel, then you find out. In fact, this was more of a financing trade, which is true of a lot of trades in the commodity markets. Have a financing aspect to them, and these trades that Trafigura was doing with entities linked to Pratik Gupta was more of a financing trade. So Trafigura would buy the cargoes and then would sell them back either to the same company they bought them from or to another company nominated by Pratik Gupta. So they were never actually delivering them to an end consumer, which now that we see the full story of the alleged fraud, you can understand why they weren't ever being delivered to a real consumer. But that also meant that Trafigura was never opening them and finding out about them. Of course, the whole story does definitely point some fingers at shortcomings in Trafigura's processes. For example, they weren't getting certificates of analysis analyzing what was in the containers when they were paying for them. I already mentioned this issue of the paperwork, the discrepancies in the paperwork. Another really simple one is they were doing all of these trades and they were taking title of these goods, but in reality they were doing a financing trade, as I just explained. Would Trafigura have lent $500-600 million? Would Trafigura's treasury have approved a $500 or $600 million loan to Pratik Gupta and companies connected to him? I suspect they wouldn't have done, but I also suspect that they didn't see this as a loan because it was a physical trade, and that's also a bit of a shortcoming, because essentially it was a type of repurchase agreement, which effectively was a loan with physical collateral, but then it turned out that the physical collateral didn't exist or wasn't what it was supposed to be. So yes, I do think this story points to a number of shortcomings in Trafigura's processes, and I think Trafigura itself has recognized that.
Well, one more question in that respect. Is it common practice that material that is not about to be sold to consumers is not tested? We are talking about thousands of tons, so they should have detected it. You said the management has a lesson to learn. I think they should better look for a new job. They should have detected it earlier. So is it common practice that it is not tested if we are talking about thousands of tons that are put into or stored into a warehouse?
I mean, there's probably people in the audience who are more into the physical logistics of the metals industry than I am. But my understanding is that, yes, it is pretty common practice that it's not tested. You know, nickel, for example, and I think this was true of the nickel, or the supposed nickel, the non-existent nickel that Trafigura was trading, is often shipped in bags. Usually, most people in the supply chain don't really want the bags to be opened, because one of the things they rely on to ensure that they are getting the real thing, that they're not being the victim of fraud, is the seals that the producers put on the bags when they close the bags. So if you're buying nickel briquettes from BHP Billiton or produced by BHP Billiton in Australia, BHP Billiton will put a BHP Billiton branded bag in with the nickel briquettes in it. They'll seal it, and what everyone is doing at various points in the supply chain, including, for example, the warehouses, if it goes onto the LME, is checking that the seals haven't been tampered with. They'll check the weight, they'll check that the seals haven't been tampered with, and that's one of the reasons why it was possible for example, earlier this year, when we saw this rather bizarre, relatively small story, but still eye-opening, of a few LME warrants for nickel, which turned out not to contain nickel. Again, the issue was that it's nickel in bags, and actually people aren't doing an analysis of the nickel when it goes into a warehouse, because nobody really wants the bags to be opened. But that does create an opportunity for a clever thief, and that's what appears to have happened at some point in this LME story.
Yeah. Thank you for the question, Kevin. Thank you, Jack. We have time for one or two more questions. Frank?
Jack, thanks a lot. I'm Frank, co-founder of MetalsHub together with Sebastian. I've got one more question. So some of the big traders have been also accused of price manipulation. And of course, if you move a lot of material, you have an influence on the price. And even Glencore has been fined for that as well, alongside with this bribery discussion. When I recently challenged fast markets over it, with regards to their indices, who are entirely journalistic, they said that those are things from the past. Would you agree?
I try not to pass judgment on those kind of questions. I mean, I've been hearing from my commodity trader contacts ever since I started writing about this industry that, for example, the stories of bribery or of price manipulation are in the past. And then I read press releases from the US Department of Justice or the Commodity Futures Trading Commission announcing that they've admitted to paying bribes or manipulating markets. So I try to maintain an open mind. I do think the industry has changed in lots of different ways. Compliance has become a much bigger part of it. But I wouldn't like to definitively say that it's in the past until we've seen a period of a number of years when there haven't been any of these stories about price manipulation and or bribery. I think, you know, in some of these examples, there was some market manipulation in the Vitol case and also in the Glencore case, which involved oil products markets and in particular locations in the US and price assessments where Glencore and Vitol traders were submitting quotes to the price reporting agencies that were designed to push the market in a particular way. That's clearly a risk. It's a risk that the price reporting agencies are totally aware of. It's the obvious way, if you wanted to set out to manipulate a market that is assessed by a price reporting agency, that is the obvious thing to do, right? So it's not like it's a risk that people are not aware of, and price reporting agencies clearly have safeguards in place to try and stop that happening. All of the big commodity traders now have fairly substantial compliance teams to try and stop their traders from doing that because they don't want to be fined by the Americans. Does that mean that it will never happen? I don't know. Time will tell. I will be here waiting to report about it if it does happen.
Yeah. Thank you, Jack. I also have a question for you. Most of you know my favorite metal is nickel. Now later here on stage we will welcome Matthew Chamberlain, the CEO of the London Metal Exchange. In your opinion, has the LME done a good job of restoring the confidence in the nickel market and shedding light on what has happened in these days when the nickel market struggled last year?
That's a big question. I think they've done a lot of what they could do. If I think about what the LME has done wrong in this whole story, I think the most obvious things that they've done wrong were in the run-up to March the 8th, 2022, rather than since then. On the morning of March the 8th, I think they were in a very difficult situation, and I don't think there was any really easy choice of action. I think they clearly failed in terms of monitoring the market, regulating the market in the run-up to that point, including in the 24 hours before then, when they could have suspended the market at some point before then, and we probably would not have had any of the mess that did happen, or indeed in the weeks and months before that, when, for example, Bloomberg was reporting back in mid-February that Tsingshan had a large short position in the nickel market that was getting squeezed. So they should have been aware of it. But since then, actually, I think they've done a lot of the things that needed to happen. I still think it's going to be, and you know, they're in a difficult position because they have lots of different people pushing on them in different directions. You know, they've got these legal cases from several hedge funds, which affect how much information they can share, for example. They've got the regulators pushing on them, and they've also got the the desire from the market to restore normal trading in nickel, I think it's going to be a long uphill struggle to get the nickel market back to what it was before March 2022. I have been a bit surprised that there hasn't been more attempts by some of the LME's competitors to capitalize on their challenges and launch competitor products. That hasn't really happened in any big way yet. And I think that does provide a possibility for the LME to continue with this process of taking actions to rectify the situation. You know, one of the main things they're doing that's you would think should aid market liquidity is listing a lot of new producers, particularly Chinese producers, who are going to be producing nickel metal for LME delivery. And over time, that ought to rebuild liquidity in the LME nickel contract. And it might be that they can get through this, but I think it's inevitable that the reputation and the standing and probably interest and liquidity on the LME has been damaged and will be damaged for a long time. I think it's going to take a long, long time to come back from this if they can.
Thank you very much, Jack. I think that's worth an applause. I think